Most people believe a global crisis destroys wealth. History shows the opposite. In fact, the gap between people who panic during a crisis and those who stay invested is often measured in decades of lost returns. And the reason most investors get this wrong has nothing to do with intelligence. It has everything to do with what they're watching. Imagine two investors, same age, same job, and same amount of savings. Every morning, one of them watches financial news. The other reads history. Then one day, a major geopolitical crisis breaks out. Both investors receive the same alerts. Both see the same red charts. Both hear the same warnings. But what they do next sends their financial futures in completely different directions. Here's what the financial media never leads with. Your fear is not just a side effect of the coverage. It's the product. When global tension rises, viewership rises. More viewers mean more engagement. More engagement means more advertising revenue. Every alarming headline, every urgent panel discussion, every breaking news alert generates clicks. And clicks generate profit. The more uncertain you feel, the longer you stay tuned. And the longer you stay tuned, the more ads you see from the same platforms that profit when you trade. This is not a conspiracy. It's simply a business model. A business model powered by your anxiety. But there is something inside this system that they rarely show you. Because if investors understood it, they would panic far less. And they would trade far less. And the entire attention machine would slow down. Across more than a century of economic history, the data shows something remarkably consistent. Geopolitical shocks rarely destroy markets. They disrupt them temporarily, and then markets recover, often faster than most people expect. Investors who understand this follow a very different playbook. 4 principles separate informed investors from reactive ones. Principle 1. Build a financial floor. Before you build wealth, build stability. 6 to 12 months of living expenses, held in liquid, low-risk accounts. This is not an investment strategy. It is psychological armor. Without it, every market dip feels like a personal emergency. With it, volatility becomes something you can simply wait through. Principle 2. Understand crisis spending. During large-scale geopolitical crises, governments do something predictable. They spend, and they spend aggressively. Logistics, infrastructure, energy, manufacturing, defense, communication systems. This spending flows directly into the companies that provide these services. In many cases, the government becomes the largest customer in the entire economy overnight. For investors paying attention, that's not a signal to panic. It's a signal to look closely. Principle 3. Watch the essential sectors. When stability breaks, certain sectors historically become more resilient. Defense, energy, consumer staples, real assets. These industries are not exciting. They are essential. People don't stop buying food, medicine, electricity, or fuel because headlines become frightening. Demand continues. Sometimes it even increases. Principle 4. Never abandon index investing during a crisis. Institutional research across decades shows something surprising. Long-term index investors who stayed invested through major conflicts often earned higher returns than during calm periods. Why? Because crisis economies are often stimulus economies. Governments inject massive spending into the system, and markets eventually price that in. But here is the most important statistic. Missing the 10 best market days in a 20-year period can cut your final wealth by more than half. And 7 of those best days typically occur within 2 weeks of the worst days. The crash and the recovery are often the same moment. Consider one of the largest geopolitical shocks in recent history. On the day the crisis began, the broad market fell sharply. Financial headlines turned urgent. Panic spread across trading platforms. But within hours, the market began to recover. Meanwhile, sectors like defense and energy surged into double-digit gains. Many retail investors hadn't even finished reading their first analysis article before the recovery had already begun. Investors who sold that morning locked in their losses permanently. Taxes, missed recovery windows, loss compounding. But investors who held their positions and in some cases added to them came out significantly ahead. The difference wasn't intelligence, it was preparation. The investor who watched hours of crisis coverage and sold everything didn't feel reckless. He felt rational. He felt informed. He felt like he had finally seen through the noise. That's the strange thing about panic selling. From the inside, it feels like clarity. The other investor turned off the coverage. She checked the structure she had already built, her emergency fund, her diversified holdings, her long-term plan. Then she made coffee and did nothing to her portfolio. And that nothing continued compounding. By the time a crisis becomes front-page news, The emotional trade has already happened. The crash will dominate the headlines. The recovery will barely be mentioned because panic drives attention. Recovery does not, and attention is the currency of the media industry. Markets have survived 2 world wars, regional conflicts, financial collapses, and global economic shocks. Every single time, the investors who had a plan before the crisis and stayed with that plan during the crisis came out ahead. You can be that investor. But the decision has to be made now, not when the headlines turn red. If this changed the way you think about crisis and investing, subscribe. Because the most valuable financial knowledge isn't what's trending in the news, it's what history has already proven.